Taxes, in their simplest form, are mandatory contributions from individuals and corporations to help fund public goods and services. These funds are managed by the government, and they play a pivotal role in the development and maintenance of our society. From building roads and schools to funding healthcare and defense, taxes are the lifeblood of our nation's infrastructure. Yet, taxes are far from a one-size-fits-all concept. There are different types of taxes, each with its own set of rules and regulations. Let's briefly touch upon some of these. Firstly, we have income tax, a direct tax levied on your earnings. This includes wages from your job, profits from your business, and income from investments. It's progressive, meaning the more you earn, the higher your tax rate. Secondly, we encounter sales tax, an indirect tax you pay when you purchase goods and services. This tax is typically a percentage of the purchase price and varies from state to state. Then there's property tax, a levy on the value of property you own. This includes real estate like homes and land, but can also extend to vehicles and other assets. This tax is typically used to fund local services such as schools, parks, and emergency services. Lastly, let's highlight corporate tax, a levy on a company's profits. While this might not directly impact your personal tax bill, it's an important part of the overall tax landscape. Understanding these types of taxes and how they function is the first step in becoming a savvy taxpayer. It's like learning the rules of a game before you can start playing strategically. With a firm on the concept of tax, we can now explore methods to save on them. Stay tuned because in the next segments we'll be diving into the nitty-gritty of tax brackets, deductions, credits, and more. So buckle up as we embark on this journey to financial enlightenment. Understanding your tax bracket and rate is the key to efficient tax planning. Now let's dive a little deeper into this. Tax brackets and rates are essentially the structure of our tax system. Picture a ladder with several rungs. Each rung represents a different income level, and each has its own tax rate. This is what's known as a progressive tax system. As you climb up the income ladder, you move into higher tax brackets. But here's the kicker. The higher rate doesn't apply to all of your income, just the amount that falls within that bracket. So if you're in the third bracket, you're not paying the third bracket's rate on all your income, just the portion that falls within that bracket's range. For example, let's imagine the first bracket is from $0 to $20,000, taxed at 10%. The second bracket is from $20,000 to $40,000, taxed at 15%. If you make $30,000, you're in the second bracket, but you're not paying 15% on the full $30,000. Instead, you're paying 10% on the first $20,000, and then 15% on the remaining $10,000. This system is designed to be fair, ensuring those with higher incomes pay a larger proportion of their income in taxes. It's also why understanding your tax bracket is so crucial. The more income you have in a higher bracket, the more tax you'll owe. Conversely, if you can find ways to reduce your taxable income, like through deductions or credits, you might be able to drop into a lower bracket and save money. So, you see, understanding tax brackets and rates isn't just about knowing what percent of your paycheck goes to Uncle Sam. It's about understanding how much of your income falls into each bracket and using that knowledge to your financial advantage. Knowing your tax bracket can help you make informed financial decisions. So stay tuned as we dive into tax deductions in the next scene and uncover more ways to take control of your financial future. One of the most straightforward ways to reduce your tax burden is through tax deductions. So, let's dive right into it. What are tax deductions exactly? Picture them as discounts on your taxable income. They reduce the amount of income that's subject to tax, which in turn decreases your overall tax bill. Sounds pretty sweet, doesn't it? There are several types of tax deductions, but we'll focus on the most common ones: the standard deduction, itemized deductions, and above-the-line deductions. Firstly, the standard deduction. This is a flat amount that you can subtract from your income before income tax is applied. The amount varies depending on your filing status, but the beauty of the standard deduction is its simplicity. No need to keep track of receipts or do any complicated calculations. It's as straightforward as tax stuff gets. Next up, we have itemized deductions. These are specific expenses you've incurred throughout the year that you can deduct from your income. They include things like mortgage interest, state and local taxes, charitable donations, and medical expenses. The catch is, to claim itemized deductions, you need to have proof of these expenses. So, if you're going this route, make sure you're organized and keep those receipts. Lastly, we have above-the-line deductions. These are deductions you can take to reduce your adjusted gross income, and they're called above the line because you can take them regardless of whether you itemize or take the standard deduction. Examples include educator expenses if you're a teacher, student loan interest, and contributions to certain retirement accounts. Now, a word of caution. While deductions can significantly reduce your tax bill, they're not a one-size-fits-all solution. Your individual situation will determine which deductions are most advantageous for you. It's always a good idea to consult with a tax professional to ensure you're maximizing your tax savings. Strategically using tax deductions can significantly decrease your taxable income. And in the world of taxes, less income means less tax. So understand your options, keep good records, and don't be afraid to seek professional advice. It could mean the difference between a hefty tax bill and a happier bank balance. Like tax deductions, tax credits are another great tool for tax savings. Now let's take a closer look at what tax credits are and how they can be a game changer in your financial journey. In essence, tax credits are a dollar-for-dollar reduction in your tax liability. This means that for every dollar of tax credit, your tax owed decreases by the same amount. Unlike tax deductions, which reduce the amount of your income subject to tax, tax credits directly reduce your tax bill. There are several common tax credits that you might be eligible for. Let's delve into a few of them. First up is the Earned Income Tax Credit. This is a refundable credit designed for individuals and families who have low to moderate income from working. The amount of this credit varies based on your income, marital status, and how many children you have. Next, we have the Child and Dependent Care Credit. If you're paying for the care of a child under 13 or a dependent of any age who is physically or mentally incapable of self-care, you may qualify for this credit. The expenses must be related to allowing you to work or actively look for work. Finally, let's talk about education credits. If you, your spouse, or your dependent is currently studying at an eligible educational institution, you may be entitled to either the American Opportunity Credit or the Lifetime Learning Credit. These credits can help offset costs of tuition, course materials, and certain fees. Remember, these are just a few examples. There are numerous other tax credits, like those for energy efficiency, health insurance, and more, that you might qualify for. To claim these tax credits, you'll need to fill out the appropriate IRS forms and meet certain requirements. Be sure to consult with a tax professional to ensure you're not missing out on any potential savings. Applying for eligible tax credits can further reduce your tax liability, so don't leave money on the table. Make tax credits work for you and keep more of your hard-earned cash where it belongs, in your pocket. Investing in retirement accounts not only secures your future but also offers tax benefits. Now let's delve into the concept of retirement accounts like the 401(k) and individual retirement accounts, or IRAs, and how contributions to these accounts can shave off a significant chunk from your tax bill. Picture this: you've been working hard earning a paycheck, but instead of spending all of it, you decide to stash a part of it away into a magical box called a retirement account. This box is magical because the money you put inside is tax deductible. That means it reduces your taxable income for the year. So if your yearly income is $100,000 and you contribute $10,000 to your 401(k), you're only taxed on $90,000. Sounds like a good deal, right? Now there are two main types of retirement accounts you might come across: the 401(k) and the IRA. The 401(k) is often offered through your employer, and sometimes they even match a portion of your contributions. It's like getting free money while also saving on taxes. On the other hand, an IRA is something you can open on your own, outside of your workplace. Both these accounts come in two flavors: traditional and Roth. Contributions to a traditional 401(k) or IRA are made pre-tax, meaning you don't pay taxes on that money now but will when you withdraw it in retirement. With a Roth 401(k) or IRA, it's the opposite. You pay taxes on the money now but can withdraw it tax-free in retirement. So, which one should you choose? It really depends on your current tax bracket and where you expect to be in retirement. If you think you're in a higher tax bracket now than you will be in retirement, the traditional route might be the best. But if you're just starting out and in a lower tax bracket, the Roth might be a better bet. Contributing to retirement accounts is a win-win. You save for your future and save on taxes. So why not start investing in your future self today? HSAs and FSAs are often overlooked but can offer significant tax advantages. Let's dive right into the world of health savings accounts, or HSAs, and flexible spending accounts, also known as FSAs. These are special types of accounts that you contribute to, often directly from your paycheck, to cover eligible healthcare expenses. HSAs are available to those enrolled in high-deductible health plans. They allow you to stash away money, pre-tax, that you can then use to pay for a wide range of eligible medical expenses. The beauty of an HSA is that any money you don't use in a given year rolls over to the next, and the account stays with you, even if you change jobs or health plans. Plus, these funds grow tax-free, and withdrawals for eligible expenses are also tax-free. Talk about a triple tax advantage. On the other hand, FSAs are typically offered by employers, and like HSAs, they let you contribute pre-tax dollars to pay for eligible healthcare costs. However, there are some key differences. First, FSAs have a use it or lose it rule, which means that if you don't use all the money in your FSA by the end of the plan year, you risk losing it. Second, FSAs generally don't follow you if you switch jobs or health plans. But don't let these differences deter you. Both HSAs and FSAs offer significant tax advantages. Your contributions reduce your taxable income, which could potentially drop you into a lower tax bracket, saving you even more. Plus, they offer a convenient way to budget for healthcare expenses. By strategically using these accounts, you're essentially paying for your medical expenses with pre-tax dollars, which could save you a significant amount in the long run. So, if you have access to these accounts and you're not using them, you could be leaving money on the table. In conclusion, it's worth exploring HSAs and FSAs as part of your tax and healthcare strategy. They might seem complicated at first, but once you get the hang of them, they can be a powerful tool for saving on both healthcare costs and taxes. Utilizing HSAs and FSAs can help you save on both healthcare costs and taxes. Let's delve into the fascinating world of education savings accounts, or ESAs, and how they can help you save for future education costs, while also providing a tax break. Education savings accounts are specialized investment accounts dedicated to future educational expenses. Two primary types of ESAs are the 529 plans and Coverdell ESAs. The 529 plan, named after Section 529 of the Internal Revenue Code, is tax-advantaged savings plan designed to encourage saving for future education costs. 529 plans are sponsored by states, state agencies, or educational institutions, and are authorized by Section 529 of the Internal Revenue Code. On the other hand, we have the Coverdell Education Savings Account, named after its advocate, the late Senator Paul Coverdell. This plan allows families to invest money in a special account to be used for a child's education expenses. Now you might be wondering, how do these accounts grow tax-free? Well, when you contribute to these accounts, your money is invested, and the earnings from these investments are not subject to federal taxes and in most cases state taxes as long as the funds are used for eligible education expenses. This feature makes them a fantastic tool for saving for education. These accounts can be used for a variety of education-related expenses, including tuition, room and board, textbooks, and even computers. The magic of these accounts lies in their ability to grow over time, creating a nest egg for future education costs. However, keep in that there are contribution limits and other rules associated with these accounts. It's crucial to understand these details before opening an account. Investing education savings accounts can help you save for future education costs and save on taxes. So consider making the smart move towards a brighter, tax-efficient future by investing in an education savings account. Saving on taxes is not a one-size-fits-all strategy, but a combination of various methods. We've walked through the basics of tax, explored income tax brackets and rates, delved into tax deductions and credits, and touched on the benefits of retirement, health, and education savings accounts. Understanding these aspects of taxation is the first step to financial success. Each of these facets offers its own set of opportunities to save on taxes and, when used strategically, can help you keep more of your hard-earned money in your pocket. Remember, knowledge is power. The more you understand about these tax-saving methods, the better equipped you'll be to make informed financial decisions. It's not just about saving today, but setting up a financially secure and stable future. So here's your call to action. Keep learning, keep strategizing, and take control of your finances. If you found this video helpful and are ready to take control of your financial future, don't forget to subscribe.